So this time they're going to have to raise money from bank reserves themselves, and bank reserves are going to plummet, I think, significantly below $3 trillion. And at some point, something is going to hit a snag, and then we're going to have an avalanche, and the Fed's going to have to reverse from QT to QE, cut to zero, bam, print $3-4 trillion in a matter of weeks. And at that point, I think the accounting worlds and the physical world are going to go their separate ways.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 6th through January 13th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Rafi Farber from the Endgame Investor. Rafi, thank you so much for your time today.
Thanks for having me back, Elijah. Good to be back.
Well, it's great to have you today. You just wrote an article on Substack. Also, I think it's good to know that this is publicly available, so we'll put a link to the description of it, or put a link in the description of this video to the article. And if people find this article interesting, they might want to also subscribe to your Substack there. The article is about how really accounting tricks cannot solve the U.S. debt situation. And I guess if you can explain a bit more about this and maybe some of the arguments that people are putting forth out there on the interweb that really don't make a whole lot of sense.
In terms of accounting, it makes sense. It goes like this. I think Finance a lot of your subscribers and followers will probably be familiar with that Twitter account. He's pretty good. I mean, I like the account. I like Finance a lot, no pun intended. Don't agree with him on everything, but on this particularly, I think he's completely wrong. His argument, in an isolated sense, makes sense. He's arguing that, okay, so interest rates are going to go up. And if interest rates go up, the price of bonds goes down. And when interest rates go up, that means the dollar gets stronger. And if the dollar gets stronger, then the Treasury could just theoretically buy back all of its own debt, cancel it, and then we go back to zero and everything's fine and we start inflating again. I mean, that was the implication of it. So I agree with the technicals of that. It's theoretically possible that the value of U.S. debt goes down so much that the Treasury has enough dollars to buy it all back, and then cancel the debt. Okay, but then what happens in the wreckage of that? And Finance a lot. He says this. He says this pretty explicitly. I don't remember the exact words he uses, but America goes back to its strong position. Suggesting that the reserve currency status isn't affected and everything goes back to normal, and that's it. And by him saying that it's a genius move, he's saying that everything's going to be fine after that. The big problem with that, just in a very broad stroke sense, is that this is an accounting gimmick, right? And what he's saying in this tweet is that all that was wrong with all this money printing and this debt monetization and all the inflation that has led to all the wars and all the malinvestment, all the destruction of property and the destruction of wealth. It just depends how you count it, right? If you just cancel the debt and then buy it all back, then everything's fine. Like nothing ever happened. And that's really the mistake that the Keynesians make and all the other academic economists make. That think they can control human behavior with equations. They think that, well, if you count the numbers in the right way and you do this and that and you massage things, then you can print as much money as you want and you can spend it on whatever you want. And the accounting world sort of like magically bleeds into the physical reality world, and you have this like magic potion, right? None of that is real, right? Accounting is a trick that we use to organize real assets in the world, so we know that where they are and how much they are and how much needs we can actually satisfy with this real stuff on planet Earth. We use accounting in order to organize things. The thing is, you can lie about the accounting. That doesn't change the physical reality of what's going on. Right? So like imagine Elijah, that you have money in your garage. Right, you have like gold coins, silver coin. Maybe you do. I don't know. I'm not saying that you do, but maybe you do. And you put me in charge of them, right? To like as your accountant, and I'm supposed to like give you a note about how much money and real assets. Let's not even say gold and silver. Let's say like wheat and barley and food, and, that you're stacking for an apocalypse. Let's make it real more realistic. That you're putting me in charge of your bunker for the end game, for the apocalypse, and I'm giving you a statement. And when I give you this statement, like I give you a piece of paper for every 1,000 bushels of wheat that you have, and another piece of paper for every 1,000 bushels of barley, and then for gold bars, et cetera, et cetera. You have all this paper accounting, right? And let's say you trade these things with your other prepper buddies who watch Reluctant Preppers and Liberty and Finance, and at least you have this like internal economy. But let's say like I'm actually stealing your stuff from your bunker without telling you, because you trust me, I have the keys, and you're trading all this paper, and you trade with your prepping buddies, and then when it comes down to it, and the SHTF, and you go down into your bunker, you realize that I took it all. Right? The accounting that you're pretending that you have all this stuff and you're trading these papers with your friends, it's not going to change the fact that you don't have anything. Right? So when things are really bad, all of a sudden accounting does not match with what you have discovered the physical reality to be, and you're just as screwed as you were when you were trading these papers around and getting assets from that trade. None of it was real, right? And then you experience hyperinflation, and then it's done, right? So that's just from like a broad strokes perspective. You can't pretend that accounting is what's real here, and it's the accounting that's the problem, and it's and the physical reality is not really connected to it. The other thing is you can explain it just more directly, more causally than that, and that is that the Fed's balance sheet is the dollar. It's the asset side of the dollar. The dollar is a liability, and what backs the liability is mostly Treasury debt, about 94%, if I got the numbers correct, right? Based on the fake valuation gold of $42 on the Fed's balance sheet. So if what mostly backs the dollar is the debt, if the interest rates go up on the debt and the debt becomes worthless, that means that 93% of the assets that back the dollar aren't worth anything. And so what is worth something on the Fed's balance sheet is the gold, right? So then the value of the gold goes up when the value of the debt goes down. It has to balance out. And then all the purchasing power goes to the gold holders anyway. But you can't have a situation, especially in an end game scenario, where interest rates go up and the purchasing power of the dollar goes up. It might go up in terms of other currencies that are also worthless, but who cares if the dollar index is at like 300 if the dollar can't buy anything, and nothing that the dollar can be exchanged for in the foreign exchange markets can be buy anything. It doesn't matter. Like, this is all a stupid accounting game where the physical reality is that nobody can afford anything. So that's the problem. So then you could ask, the question is, then why is that what happened in the late 1970s and 1980? Why is it that the dollar went up as interest rates went up? I mean, it was the high interest rate that saved the dollar. You could argue that, and I'd sort of agree with you that Volcker hiked interest rates to 20%, and that's what saved the dollar, and we're on the fumes of the tank of that fiat gasoline today. So why did it work that back then, and why would it be different now? Well, the difference is that the interest rates are really high, but even though the interest rates are really high, the value of the debt was still solid because the U.S. could still afford to pay 20% interest rates in 1979, 1980. It was still doable, and investors knew that. Right? Real investors are like, wow, look at that, 20% interest rates on a treasury bond. Yeah, sure. Let's buy that. 1980, 1981, gold looks a little bit overvalued here. I mean, it's $850 an ounce. It's like 130% of the Fed's balance sheet. We're already on a gold standard. So forget that. Like gold has had its time. Let's buy some treasuries, earn the interest. It's very attractive back then because But that's, what, 30% of GDP. It's manageable. It's a high interest rate. Yeah. So let's lock it in. Let's get it. And so it's viable and it's a good investment. But now, like, who thinks that the US can pay 20% on a 10, 20, 30 year bond now? That's insane. It's not going to happen. Maybe they could in dollars that are worthless. And that's why gold's going to go up now as interest rates go up and not down. Right? So as interest rates go up, the dollar is going to weaken, not strengthen. It's going to be the opposite of what we saw in the late 1970s, 1980, except gold's going to go up much higher this time until everything balances out.
It does seem pretty intuitive that, just some accounting trick can't really solve a crisis like this. And you mentioned how really there's no way then out of the end game, because the end game is really tied to how the currency, in your view, is failing and the US debt is going exponential. So what does this then look like? As you mentioned how the dollar is going to be weakening. What does this mean for the markets? As you mentioned, dollar denominated assets, all of that.
What does it mean that the dollar is going to be weakening? It doesn't necessarily mean that the dollar is going to be weaker on a foreign exchange market. It could be stronger, but that is stronger relative to what? Well, it's relative to assets that are becoming worthless faster and faster and faster. So we could see, and I think we're going to see, the dollar become stronger and stronger on foreign exchange markets, and all the other currencies that are based on the dollar pour into the dollar itself. Because remember, other currencies are derivatives of the dollar themselves, and that's what the post Bretton Woods system has set up, right? The U.S. put, after it won World War, after it conquered the world, basically fiscally. It might not have conquered the world, in terms of placing its population all over the place. It sort of did do that, not entirely, but what it did do is it stuffed its dollars into every other central bank, so it conquered them monetarily, right? And so that makes every other currency a derivative of the dollar, essentially, because every other central bank owns dollars, and that's what gives them their value, and that's hard for people to accept. That's how it is. So we should see that's going back to the dichotomy between accounting and physical and real physical reality. We should see the world start to separate, right? As long as inflation remains muted in a way that the public isn't like koretegar. It's Hebrew. It's not calling out. It's not calling it out as a fraud yet. Then you can have the accounting world and the physical reality world sort of agreeing or looking like they agree, more or less, because people aren't checking. They're not checking their bunkers for what's actually there. But as these worlds separate, we should see the dollar get stronger in the accounting world, but get weaker and weaker in the real physical world. So the dollar index going up, but commodity prices going up even faster. Then the dollar index goes up, and gold going up the fastest because it's the most liquid. That's what we should see, and that process, the separation of the accounting world from the physical reality world, where they reflect each other less and less and less, until everyone just says, like, the accounting world is fiction, forget it. Then they'll let the banks trade the foreign exchange. And then at a certain point, like, even the banks say, like, this is an accounting gimmick, and I can't really buy anything with my salary anymore. So then all the banks go into commodity futures and real assets, and then you have like the global rush into real stuff, which is led by gold and silver because they're the most liquid. This is how it happens.
It seems like we see that throughout history, right? When currencies fail, people go into gold and silver, real money. I did want to get into some of the specifics, maybe some of the cracks we're seeing happening right now. You mentioned in the article that the Treasury checking account, the Treasury's checking account at the Fed, is being drained into bank reserves. What do you think the significance of this is?
What I'm tracking, I'm always looking for the proximate trigger for what is going to lead to this avalanche. I think where I think we are now is like the snow is ready. It's like stacked there, And you just need like one stone to like throw it at the right angle, and then a whole avalanche comes down, and the skiers are in trouble. So I think I'm looking for where the weak spot is that's going to cause the avalanche. I think we're like one stone's throw away. And what I'm looking at is the bank reserves level of somewhere below $3 trillion, which is where the last bank crisis was triggered. So, I think it's a safe. It's a safe bet. I'm not saying place a bet, but I'm saying it's a safe inference that the $3 trillion bank reserves level should trigger something when it's hit again. And we did hit it on the year-end term. We hit it at the end of December, which is expected because that's when banks take all their extra cash and they just like stuff it in the Fed, so that it's not on their balance sheet, so they look nice and skinny, and that like reduces their fees for whatever regulatory reason. So we did see bank reserves fall below $3 trillion very briefly. But then again, it took several months, like 2 or 3 months of a reserves level below $3 trillion to trigger the regional banking crisis. So we need to stay below $3 trillion for a while, maybe a few months, before something really big starts to happen. So what's happening now is that the debt ceiling has been hit, right? It can't raise any more debt, meaning the Treasury, what that means mechanically is the Treasury cannot suck any more money out of bank reserves to itself to spend. So what they're going to do is what's going to happen is they're going to start drawing money down, and they already are starting this. They're going to start drawing money down from their checking account, which is not considered bank reserves, and that money is going to be spent down into bank reserves. So bank reserves are going to go a little bit up, and then the extra money is going to go back into reverse repo. And then what I think is going to happen is they're going to stay more or less stable, like around the $3.2, $3.3 trillion mark, up and down there by $100 billion every week, until the debt ceiling is raised. And when the debt ceiling is raised, all of a sudden you're going to see, like we saw last time in June 2023. What did it say? Did they start falling in 2020? I think it started falling in June 2023. Yeah. What happened was that reverse repo started to fall as the Treasury started to sell more debt, and then banks took the money from the reverse repos and bought Treasury bills, and so the money went out of reverse repos into the banking system. And the thing is now, back then, like the government could afford to do that without triggering some kind of catastrophe, because there was like $2.2 trillion stuck in reverse repos that could have been used. But now there's like $150 billion. It's basically zero. I don't want to call $150 billion zero, but like in the scheme of things, it's not that much. So there's not going to be any kind of buffer this time when the debt ceiling is raised, and all of a sudden the Treasury goes from a $0 balance. And we all know, we've seen this before, the Treasury is not going to solve this problem is going to be solved until the Treasury's account goes very close to zero, and then all the politicians say, I got to save the country and raise the debt ceiling. They're going to raise it to whatever it's going to be, and then the Treasury is going to raise hundreds of billions, $500 billion, up to $1 trillion in short-term debt just to fill its account. And but where's that money going to come from this time? Last time it came from reverse repos. This time those dollars don't exist anymore because of QT. Right? They're all gone. So this time they're going to have to raise money from bank reserves themselves, and bank reserves are going to plummet, I think, significantly below $3 trillion. And at some point, something is going to hit a snag, and then we're going to have an avalanche, and the Fed's going to have to reverse from QT to QE, cut to zero, bam, print $3-4 trillion in a matter of weeks. And at that point, I think the accounting worlds and the physical world are going to go their separate ways.
It is scary, especially if we do see bank reserves falling, because we saw a little bit of that when we had the 2023 banking crisis in March and April. But this time it could be maybe that on a much bigger scale. Would that be your view? Yeah.
It's going to be on a bigger scale. It just depends. There is a sector somewhere that is weak. In 2023, the weakness was revealed in digital banking. This time it could be revealed in some other group of banks. Maybe like the big ones that have those large, I'm just guessing, I don't know, this isn't a prediction, but Bank of America has these large unrealized losses, which should be getting worse and worse because interest rates are going higher and higher. They just jumped like 10 basis points on Friday. So it could start in a very big bank, which could start a domino in all the other banks that have these large unrealized losses. So instead of Silicon Valley, it could be Bank of America. But I don't know. I don't know what it's going to be. But it's going to be something bigger, and it's going to spread. And the Fed is going to have to print or die, or print and die more accurately.
Another point you make in the article, if you wanted to stress this again regarding the rates we're seeing right now, how it's very strange that the Fed is cutting rates, but we're seeing Treasury yields rise. And you mentioned actually that we have seen something like this happen back in the 1970s, I believe. And this happened during the worst stagflation we saw in the dollar's history. So can you expand on that?
Yeah, I think what I said was, I think I was quoting Wolf Rifter, who's also he's a really good, financial reporter, pretty good on government stats and stuff like that. So if he was saying that he's not sure if this has ever happened before, that interest rates have risen, 114 basis points from the bottom since the Fed cuts started, right? And so the Fed has cut 100 basis points, but the long term, the 10-year, 20-year, 30-year notes and bonds have gone up. I think he said 114 basis points. I think it's higher now. I think it's 120, 130. And he said he wasn't sure if this has ever happened before, and he's right. It's never happened before to this extremity, but we have seen in the past, in the 1970s, where the Fed was cutting, and during that time overall, they were cutting the Fed funds rate, but the long-term treasuries were falling in value, meaning long-term interest rates were still rising, not as sharply as they are now, but it was happening. That was 1974 to 1975. That was the meat of a bond bear market. And now we're just at the beginning of a bond bear market, which started in 2021. So that was only 3 years into it. And 1975, I think the last bond bear market started in 1946, if I'm not mistaken, and it ended in 1981. So at that point, we were about close to 30 years, 46, which is 67, a little bit less than 30 years into the bond bear market. This time we're 2-3 years into it. We got a long way to go. And it should be scary for people who own, 10, 20, 30 year debt, to be at the, 3 years into a huge bear market. And these bear markets usually last many decades, and we just started one. So you might want to get out of your long-term debt and get some real assets, which is what's going to happen. And it's going to be a stampede.
What do you think is causing this? Is it just people losing? I mean, we started this interview off pointing out how, bonds are falling right now in value, right? The interest rates are rising, even though the Fed is cutting, which is so strange. Is it just people losing confidence in U.S. Treasuries, or why are rates rising as the Fed is cutting?
I hear, people like Peter Schiff making these kinds of comments, and I can't say that they're wrong, but things like long-term bond investors, they don't believe that the Fed can pay it back, or sorry, that the Treasury can pay it back anymore. They're worried about inflation. I guess that's true, except the institutions that are buying, right? It's not like they're making investment decisions like individual human beings would. They're part of this huge system, this huge machine that just chomps up liquidity, spits it, chews it up, spits it out somewhere else, and it's like grist for the mill. So the question more is what are these individual investors thinking? Because we're talking about huge banks here, or huge central banks that are the indirect bidders on these securities. What are they thinking? Why is the machine being clocked now? And I can't say it's any individual's choice. You have to look at it more mechanically, and I haven't exactly worked out how could you describe in in an Austrian economic sense, where you want to always get down to the human level, how do you describe a huge machine like this, where there's no single actor with individual desires, with these like, $100 billion bond auctions that are making decisions? What's going on here? It could be that foreign denominated debt, like, what keeps foreign central banks buying these bonds or buying dollar denominated debt? I mean, it could be foreign central banks are trying to break their relationship with the dollar. It could be political decisions like that, or that just could be exacerbating it. I mean, I'm probably going to write an article about this if I think about it more, about what exactly is causing this giant machine to clog up. And I can't really answer it right now, but this is a monster, and it's got indigestion, and we know that's going to happen. So just get out of the way here.
Now, something that people have run towards in, especially since Trump was elected, is Bitcoin. And Bitcoin made new all-time highs above $100,000. A lot of people see it as a secure asset, kind of an alternative currency, something similar to gold. But as you've mentioned on the show before, and as you mentioned in this article, you're very skeptical, and you think that actually kind of the bubble could be popping here.
Look, I've said the bubble's popping before. I don't know. I mean, I don't know if all I know for sure is that it is a bubble, because it doesn't make any sense that after the dollar is dead, that anyone would be using this stuff. I mean, I've heard so many arguments, and none of them make any sense to me, because money has to be a commodity. It has to be. Logically, there is no other option. And look, we've seen so many stories of bubbles before. It's happened so many times, and every time people get hurt. Smart people get hurt, and rich people get hurt. I think Isaac Newton was even one of the. He was one of the guys who got hurt in the John Law bubble. Am I getting that right? I'm not sure. Maybe I'm getting the times off. But like Isaac Newton, who's like one of the smartest people ever, and from who we have in Newtonian physics and the understanding of our reality as we know it until we get to quantum, but that's a different story. But like people get hurt from these things, and they happen when there's a lot of money printing. And so there's a lot of money printing now, and then there's this new thing called Bitcoin. And what is I know it's a thing. I understand it. Like people say, "Oh, Rafi doesn't understand Bitcoin." I get the point. I get the point. It's a ledger, but okay, this is going to pop, and you can already see as the market wobbles, and as interest rates wobble, and as the assets that back the dollar, debt backs the dollar because of the balance sheet, and the dollar backs Bitcoin, even though you will deny that it does, right? Because Bitcoin is on the chain, and you got to go back in the chain, and it's got to eventually go back to a commodity. There's no stopping that. That's the regression principle. That's the regression theorem, or however you want to put it. This is going to pop. I have said in the past that I think the top was in at about 37 ounces of gold. There was a marginal break of that maybe 6 or 7 weeks ago to 39 ounces of gold for like a few hours. And now it's pulled back down. So what we have now on the technical charts, at least, is a marginal break of a double top and a reversal, which if you're into technical analysis is a very bearish chart. And if you want to pull that into Austrian style interpretation, buyers would go in on what looked like to be a break of the double top to try to push momentum, and then the reversal of the momentum means that the people who pushed it above from 37 to 39 ounces of gold, they ran out of ammo, and they don't have any more, and now they're hoping that somebody else pushes it past the double top. But what we have now looks like a triple top, and that's pretty bad. Could Bitcoin go higher from here? Yeah, but it's going to pop when the dollar dies. That I'm sure of. When there's no more dollar, there will be no more value in Bitcoin. Blockchain, maybe. Bitcoin, nah.
If our viewers are interested in continuing to track these with you, they can go to endgameinvestor.substack.com. We'll put a link in the description of this video to that. Can you share with our viewers what they'll find there and any last thoughts you had?
Yeah, you will. You'll find there's a lot of free articles that I put. Whenever I go off on a philosophical rant, I usually make the article free because what my job, as I see it, is to help people understand the philosophical foundations of money, so that when you see a trap like Bitcoin, you won't fall. I'm not saying don't buy any Bitcoin. Speculation is fine. I'm not like, it's okay to speculate. I just don't rely on it for the end game. It's not really going to help you. So again, my job is to give people the philosophical foundations to be able to weather volatility, whether that volatility be in gold, which will be minimal, or the volatility in whatever is related to the end game, just to understand that this is what the end game is going to be. And once you understand the principles and the logical reasons why it has to be this way, no amount of volatility can really phase you, as long as you're not too heavily invested in the volatility. You got to also, keep yourself on ground level and keep your assets fairly close to ground level. Doesn't have to be entirely. You can speculate some, and you'll find that there. So if you know what's going on, but you want a stronger progression as to why it must be, then read my free articles. And if you want to support me more and see what I have to say about the gold and silver markets on a day-by-day basis, then become a paid subscriber.
Fantastic. Well, Rafi, really appreciate your time today as always. Thank you so much, and God bless.
Thank you, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for January 6th through January 13th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.